that was awesome. And then I got back. It was an epic travel day to get back. But, the thing that brought me back, it was like my wife, my kids, and the Not Your Average Investor show. That brought me back, baby. So here we are.
Greg, you are all the way back because we are live on Facebook. Today, Thursday, September 3rd, Not Your Average Investor Show. Today is our Thursday edition that we do our rental property of the week, and we take Q&A from the audience. I am your host, Pablo Gonzalez. My co-host, as usual, the maven of rental income properties, and now challenged to his seat as the greatest co-host ever. TBD, what ends up coming out here is Gregg Cohen. Say hello, Greg.
Hey, you know what? I'm just happy to be recognized as among the greats who have sat in this seat. And, there's more room for number one. I'm happy to be number two. Melissa killed it. So I'm just glad you guys invited me back, really.
Yeah. Well, listen, man, I missed you, bro. Like it is seeing that smile on your face, being able to hang out here on a Thursday, man. I enjoy it very, very much. And I can't wait till our next running morning. So I'm happy to have you back, buddy. Welcome. And as everybody knows that joins us on the regular, we do a little bit of housekeeping at the beginning here. This is the show that is driven by you and your questions and your interaction, more so than the Tuesday show, even more so than the Tuesday show. So I invite you to pop open that chat box. There's a little button that says all panelists. It's a blue. Drop that down, put in all panelists and attendees so that when you chat, you're not just chatting with Greg and I, you are Greg and me. You're not just chatting with Greg and me. You are chatting with everybody else, like Lee Bishop, and
throwing in a couple of like Schmurf references, and now your grammar. I don't know. Melissa might be taking over your job. I mean,
Schmurf is a word, Greg. Okay, so you can talk to people, make a new friend, and network amongst each others. And if you have a question, the easiest way to get your question answered on the show is to pop open that Q&A box on the bottom right. Put your question in there. There's a lot going on. I sometimes get lost in Greg's eyes, and there's also a chat, and we're live on Facebook. So for me to not go cross-eyed, best place is there, but I try to keep track of everything. So I encourage you to ask questions, get clarification. This is for you. We spent this hour here for you. So we want to hear from you. We want to give you value. And last but not least, tons of value at jwbwebclass.com. If what you want is just a primer on rental income properties and to download the free investor toolkit, which is one of the things we're going to be messing around with today while we show you a property so you can evaluate all of your deals and understand what rental income properties can do for you and the dollars and cents and all that good stuff. Go to jwbwebclass.com. It'll be a quality 45 minutes spent with Greg, and you take home a bunch of free goodies. So without further ado, Greg, this is your second interview today, right? This is your second. What were you doing right before this?
Well, anytime you have a big media opportunity, you want to have, like a tune-up, right? And so I knew that we had a huge opportunity today on the Not Your Average Investor show. And so I needed a tune-up, and, it was my first day back. I was traveling all day yesterday. And so there was just like this little thing called like the Entrepreneur of the Year Awards and interviews that I thought would be a great tune-up for the Not Your Average Investor show. So that's what we were doing ahead of time. Ernst & Young heads up the Entrepreneur of the Year Awards. We kind of shared this in the group. We were really honored and blessed to be included in the finalists. There's 21 companies in the state of Florida that were recognized as finalists. And this is our second year in a row being recognized as a finalist, which is pretty cool. I think there might be 2 or 3 other companies that were recognized as finalists last year and that made it again this year. And last year, we didn't bring home the hardware. We got close, but we're super excited about the chance just to be surrounded by these companies. They're such great companies. There's 4 from Jacksonville and St. Augustine that were recognized, so we're one of those 4. These companies are just powerhouses. And so we're excited about the opportunity. There's another round of interviews coming up next week, and then the decision, I think, it's in early October. I want to say October 2nd is when they make the decision, or October 8th. So we'll keep everybody posted, but yeah, that's what we were doing ahead of time. It was just a little tune-up.
Does everybody this? I imagine it's on Zoom or not in person right now, right? Like, is there? I want to network that room, Greg. I want to meet these people that you are a part of.
It was incredible last year.
Yeah.
It's all virtual now this year, of
Yeah.
course. I mean, the awards gala last year was black tie, and I mean, it was done so well. There aren't too many opportunities now where, maybe I might get nervous to speak or whatever, but I'm sitting there and everybody's being announced as the winners. And these people go up, and there's probably, I don't know, 500, 600 people in this ballroom. And I start to hear some of the winners speak, and their accomplishments and how well-spoken they were, and kind of the weight of the award just hit me. My wife was right next to me, and she's like, "Why are you nervous?" She's like, "Seen me speak a few times, right?" And I'm like, I don't think I'm going to do very well up there. Like this, it shocked me. So, yeah, I mean, I can't speak highly enough of the award, the finalist. And, sometimes it's good to feel a little out of your league, to be quite honest. And hopefully we do a good job this year.
Awesome, man. Sounds like a great opportunity. And speaking of opportunities, let's talk about 7236 Norca Drive, the JWB property of the week.
Week.
I want to keep embellishing this, man. I love the movie trailer voice. Greg, when I first look at this property, I look at this picture and I think about stuff we've looked at in the past, and this to me says this is a renovation, right? This looks like a atypical kind of look to what I'm normally seeing from your new construction homes. Is that accurate?
Expert analysis, Pablo Gonzalez. This is not new construction. This is a renovation. Point
Awesome.
1 for Pablo.
1 point for Pablo. Here's another thing I notice about new construction, about the renovation. It's about $20,000 cheaper than the last couple properties that we've had on. Actually, a little bit more cheaper than that in the previous property, which was a little bit higher, right? So lower price point.
So new construction, you're generally going to have higher price points. That should make sense for everybody, right? We're still below middle income, but JWB's price point scale is really between about 150,000 to about 210,000. Your new construction homes are generally going to be that 180 to 210, which is what we've seen. So your renovations are going to be below that. Now, this home happens to be a very large home, and overall 180,000 is lower than what we've seen in previous weeks because we've been showing some new construction properties.
Makes a lot of sense. Now we have the lower price point. We've got the renovated construction, which is different, yet the ROI still pretty similar, still pretty close to 11% here.
Yeah, and the journey to getting to almost 11% returns is going to be really fun for us to kind of walk through. That's one of the reasons I chose this property. The first reason is because it's currently available and it has almost an 11% return, right? So that's why I love this one for you if you're thinking about adding it to your portfolio. But the journey of getting there is different than what you've seen in previous weeks when we reveal properties of the week. So I'm excited to chat about that. And Pablo, I've got to tell you, your game has become so much stronger just over the last week. I don't know what happened over the last week. Melissa must have rubbed off on you here, because the way you are just maneuvering the pictures and the whole flow here, dude, you've been practicing, haven't you?
I've been, Melissa said that she has a certain standard of excellence that she applies in her work and everything. And I'm like, you know what? I need to step up my game, son. So yeah,
This is great. So,
yeah.
And then for anybody who's new here, you see those summary of returns by purchase method. The first one is if you are purchasing this property using all cash. So that's where you see $944 in total monthly cash flow. And then you see a total return on investment of 5.64%. What's happening there is you're using all of your cash. You're not getting a loan on it. So you don't have a mortgage payment, which means that your total cash flow is higher because you don't have that expense. But because you're using all of your cash, you're not using leverage, your overall return on investment is going to be lower. So that's that top section. The middle section is non-recourse financing. When you hear non-recourse financing, you should just associate that with buying it in your retirement account. Completely different set of financing. The goal there is to be break even. And there's enough to go into that for a whole nother show, but that's a different type of asset, and break even's the goal there. So being at 1.4% is actually a great return when you're buying in your retirement account. And then the bottom one is the one we quote most often, because most clients take advantage of taking on the leverage, buying it with financing in place. And that's that roughly 11% return, which is near the very top end for assets for turnkey assets in Jacksonville now. And your cash flow is almost $300 a month, which is kind of like that holy grail. If you can get to $300 a month, you just don't see it very often. So you can't get closer than $299, which is where we're at right now.
Love it, man. So I like that breakdown, right? You normally haven't gone through that quickly and efficiently like that every time. We kind of just jump right into here, right? So talk to me about, if I'm buying it cash because I want this higher cash flow, what's the profile of that investor? That to me sounds like somebody that's closer to retirement, maybe retired. So what they want is cash flow and somewhere that their money is safe. Is that kind of accurate?
Generally, yeah. I mean, so when you are getting closer to retirement, you know, you're looking at potentially losing a huge income stream of your day job. And so you want to make sure that you bring in as much cash flow as possible. And you also want to limit your risk, right? So when people are getting closer and closer to retirement, they look at it and they say, well, I value the consistent income coming in so much that I'm willing to give up a few percentage points of return in order to get more cash flow coming in per property. So it's a more conservative strategy. Now, if you look between 5.6% and 10.85%, right? And you say you might be giving up 5% of return there, but there's a missing element. All right, Pablo, if you would go down to the bottom there and add in 4% appreciation.
That's right. So little context, there is 0% appreciation put into this, right? You want to explain that?
That's right. So historically in Jacksonville, we've averaged each year 4.3% in appreciation, and that's going all the way back from 1991 through present day. So that is our historical appreciation rate. If you invest for a full market cycle, you can expect appreciation rates on your Jacksonville properties to be somewhere right around 4%. So we put 4% in there for the appreciation rate. And the reason I wanted to point that out here in this investment summary of returns is because look at what happened with the total return on investment for the cash purchase, right? If you add 4%, but you're buying it with all of your own money and the market goes up 4%, that's a 4% return, additional return on your investment. It went up from 5.6 to 9.6, right? But look down here at the conventional financing part, right? If you would go back to 0 there, Pablo, just to show it.
I was about to.
So once you add 4% appreciation onto an asset that you only put a down payment down, your returns skyrocket when appreciation happens, right? And that's what you see here. You went up from basically 11% to over 25%. So this is just something to take into account, right? There are definitely times where we advise our clients to be buying in cash, but we also go into it with eyes wide open as to what you're giving up, especially in an environment like today where you can get 4% interest rates on the debt that you would incur, right? So it's just very good to understand why. Another reason why a cash purchase might make a lot of sense is sometimes people want to put together a portfolio which is kind of like a balanced portfolio, right? So you want to have, maybe you want to buy 5 properties. Your budget allows for it. You've got that investable capital. And you might buy 3 that have financing and then 2 that are all cash. Way to kind of hedge your bets, right? So sometimes you see us kind of manipulate the cash flows, manipulate the return on investment, manipulate kind of the risk, manipulate the down payments and the total, investable capital to make sure we can put that kind of balanced portfolio together. So that's another time where you'll see maybe 1 or 2 cash purchases added to a portfolio that might have, 2, 3, 4 finance purchases. And that works really, really well, especially in retirement account portfolios when we're putting those together, when you don't have as much flexibility with reserves as you do in non-retirement account purchases.
I hear you say manipulate this and that, right? So I think of 2 things when you say that. Number 1, I think of this spreadsheet, right? Which is part of the investor toolkit that you get if you go to jwbwebclass.com, and the ability to do what I'm doing right now, right? To go 0% here, 4% there, right? Like go into this conventional financing, move all these numbers around, right? And I think that's huge just to kind of bring up, right? Like there is, no need to, if you're thinking about being in this asset class, you might as well grab this spreadsheet, use it for your calculations so you can be a manipulator as well. um,
Negative connotation there, right?
And then the other thing I think about is, we don't really talk about the fact that you build, like you are very casually mentioning the fact that you are serving almost as a financial planner for your customers and thinking about their overall financial goals and creating a financial plan that has rental income properties, takes into account other assets and whatever else they have going on. You balance that risk, and then you create a tailored plan for that investor. Is that what I'm hearing?
100%. And that's the value of jumping on the phone and talking to my team, who has built portfolios and manages over $350 million of assets just like these. And we don't sell properties in a sense, right? We understand what the client's goal is. We understand what their long-term goal is. It might be early retirement. It might be a travel fund for themselves. It might be charity that they want to give. It might be educating their kids, whatever that is. We simply understand what the cash flow required is going to be from this income stream, from these assets. And then we break that down into a number of properties that you're going to need in your portfolio in order to accomplish that. We then look at your capital that you have. We look at how much you have today, how much you're expecting to have in future years from, bonuses from your job or other investments that you want to move over into the rental property space. And then we build that plan. So when you sit down and you talk to my team, you're going to understand exactly how many properties you need to own. And then we're going to map it out. We're going to map it out 1, 2, 3, 5, 10 years. And we're going to have a very solid plan. Now, is that plan subject to change over 5 years or 10 years? Sure. Could you get it promoted and have twice as much income coming in? And maybe that speeds that up. Absolutely. Could something change elsewhere and maybe it slows it down? Absolutely. So we then match that plan with your portfolio manager on our team. We talk with you monthly about the performance of your portfolio, and we talk about your goals, and we see if anything has changed, anything in your capital situation has changed. Do we want to speed this up? Do we want to slow it down? So it's very similar to the successful model of a financial planner who understands where your income needs to be by a certain point in time, maybe to retire, and then they fill it with assets that are going to help you get there in a balanced approach depending on your risk profile. You do the same thing.
That's just so, we've talked very little on the show about that, even though I know what happens, right? Like I just find that so valuable, right? Like I when I tell people, I'm like, oh yeah, my my biggest client, JWB. Well, they essentially, you give them 40 grand and they give you a 3-bedroom, 2-bathroom house that's property managed that they built on land, blah, blah, blah. And then at the end, I'm like, and they give you somebody that manages your expectations and allows you to build the plan. And I think of those, I don't know if you remember those commercials in like the late 90s, early 2000s, maybe, that was like, what's your number, right? Like it was like it was like a T row price or something like that. What's your number? And somebody's walking around with like a $1.5 million. And I think of like, what's your number, right? Like I think of like, if this is the number that you need for your lifestyle and you're going to reverse engineer it. And I learned that by listening to the podcast that came out today, right? We repurposed this stuff in the podcast, and Rich was talking about how you reverse engineered the number that he wanted to get at into his plan. So like, that was a big aha moment for me. I wanted to share.
It's funny that you bring up that commercial because I know exactly what you're talking about. And there is a huge difference between what we do and that commercial. So you're right for like 90% of it, but there's a huge difference what we do compared to what that commercial is talking about and compared to the way most people think about planning for retirement. Most people think about that number and they think it has to be sort of like a pile of cash that they have to have, right? Most people think about retirement as I need to build up enough money, call it in a bank account somewhere or in my stock account or whatever. And then when I get there, then I'll reach that $1 million number, or $2 million number or whatever, and then I can retire. I think about that completely differently, right? I don't think it needs to be this number that you need to achieve. I'm thinking about what my passive monthly income number is, right? Because financial freedom is when your passive monthly income, the amount of income you have coming in, no matter if you put an ounce of work into it or not, once that passive monthly income is higher than your living expenses, then you have financial freedom. So it's very similar to how that whole planning process works, but we're completely different about what we're helping you attain, because passive monthly income means so much more than a pile of money, right? At the end of the day, if you work so hard, and this is what most people do, they work so hard to make money, they don't take advantage of tax savings, so they pay twice as much to the government as they should, right? And then they don't take advantage of leverage because they just keep it in the stock market, right? So it's so much harder for them to actually get to this number that, you know, ING Direct or whoever that commercial was talking about, right? So much harder for them than if they were investing in something in rental properties. But eventually they get there, and it takes them until they're 60 years old or 65 years old. Now at 65 years old, do you want to take on risk?
Are you asking me? No.
Yeah. No, I'm asking you.
No. I'm gonna use that money super conservatively because I can't take the haircut.
Exactly. So it was so much harder for you to get there than investing in rental properties. And then when you get there, you know what your financial advisor is going to tell you to do?
Invest in
Play it
very
safe, baby.
Conservative stuff. Yeah.
Very conservative stuff. So
Yeah.
think that you're going to be earning like 3% on your money, 4% on your money, right? It was so much harder for you to get there. And then when you get there, the right move is to earn very, very little returns and just play it safe and keep your money. So you're working against yourself at every point along the way. Whereas especially if you're younger and you can take out smart debt on assets that pay for itself, you're going to put yourself in a great financial position, just like we talked about here for that conventional financing return on investment, right? If you go into an asset like this and you plan to hold for 10 or 20 years, look at the type of returns that you can get, right? Versus your friend who's investing in the stock market only and is dealing with a lot of variability, and over time is only going to earn 7, 8, 9%, which is historically what the stock market produces after a 10 or a 20-year cycle. So this is the wealth generation strategy that we're just talking about right here.
Nailed it, dude. I'm glad we went down that rabbit hole. And I got other good news for you. Jake Hargrove is alive and well. He commented yo in the chat.
Oh, man, I feel so much better now. Good to see you, Jake.
There was a moment where you're talking, I'm like, I wonder if Jake's okay. Good to see you, Jake. All right. So speaking of another famous regular here, Lee Bishop, Lee Eyes of a Hawk Bishop, puts here in the question, 9% maintenance is a bit high, even for a remodel, but the house has great street presence, right? So I think he noticed something here in this 9% maintenance rate. That is something that we had talked about previously here. Can you talk about what that's all about?
Absolutely. And just a natural segue there, Lee. Couldn't have done it better myself, my friend. Thank you very much for that. And Pablo, just so we're comparing apples to apples and we're staying consistent with 9 to 11% returns, let's drop the appreciation rate out of there. All right. So our goal is always to be between 9 to 11% just from the cash flows for all of our clients. So the way to get there is not always the same. It's different for a new construction property than it is for a renovation. And we love both. I own many of both. But the way to get there is a little bit different. So for new construction, what you're going to see is you're going to see a higher purchase price typically. The rent to price ratio compared to a renovation is going to be a little bit lower. Meaning you're going to get a little bit less rent dollars than you will compared to the purchase price for a new construction home. Okay? But what you're also going to see are lower maintenance costs on average. You're also going to see lower homeowners insurance costs. And what happens is because your rent to price ratio on a renovation is a little bit better, right? You get a little bit more rental income for the purchase price for a renovation, but your maintenance costs are a little bit higher at the end of the day, and your homeowner's insurance costs are a little bit higher. At the end of the day, the way it nets out is we can still get to that 9 to 11% return. But there's something additional to talk about specifically on this one, because what Lee noticed is that maintenance rate of 9%. I'm so glad he pointed that out because that was the talking point I wanted to share with everybody here today. One of the main reasons why more people don't invest in rental properties is because they are underperforming from a cash flow perspective, right? You've heard about the horror stories from your friends, your family members, the maintenance costs, right? The tenant does this, that, the other thing, right? There's just always something breaking. Well, what most turnkey companies do is they do not track their actual maintenance cost on their client portfolios. I don't know how you run a business that's based on lowering maintenance and vacancy costs if you don't track it, but that's really the landscape out there. If you go and you look at other property evaluations, you're generally going to see 5% and 5% for your estimated vacancy cost and estimated maintenance cost, or 5% and 7% for estimated vacancy and estimated maintenance cost. Right? So it's either a total of 10% of the gross rents or 12%. This is just industry standard. And other turnkey companies have no basis for actually putting these numbers together, right? The biggest differentiator in how you actually lower maintenance costs and vacancy costs is based on the property manager. It's how you manage. It's, do you sign long-term leases? It's, do you renew leases? It's how great are you at lowering the cost to get work done because of the volume of your business. And there is a really big difference between a great property manager and a not so great property manager, right? So it doesn't even make sense that your maintenance costs and your vacancy costs across the entire landscape of turnkey rental property companies comes out between 10 to 12%, right? It just doesn't make sense. It's just not that way. What most people do is they just use industry standards. A lot of them go, they just pick one of those numbers, and they probably go a little bit more aggressive, and they go with 10% for maintenance and vacancy costs because it allows them to estimate higher returns on investment. In their mind, it allows them to sell more properties, and that is the reality of what you're facing when you're purchasing a rental property from a turnkey company. There's just no data to back up the maintenance and the vacancy costs. So I get a little heated about this because JWB is the only company, the only turnkey company that actually tracks our maintenance and our vacancy costs. We've been doing it since 2011. We have tracked this for over 1,200 clients who have purchased over 2,000 properties. So I know exactly what those maintenance costs are. And I know that there's differentiators, right? If it's a new construction property, you're going to have a different maintenance and vacancy cost than if it's a renovated property. And if it's a renovated property and it's on a septic tank versus sewer, there's going to be a difference as well. And so by knowing this data, then you can properly educate and prepare clients going in that these are the expectations. And it's the job of JWB to only put assets in front of our clients when we know that there's going to be additional maintenance expense. We're only going to put it in front of you if it still hits that 9 to 11% overall return on investment calculation. So that was a long way of saying that, Lee, you're exactly right. This maintenance rate is 9% on this. And the reason is because this home is a renovated home on a septic tank. And for any of us who have invested in rental properties before, you all should know that being on a septic tank means that you're going to have higher maintenance costs than if you're on city sewer. It's just real. So there's nothing wrong with buying a property that's on a septic tank. I own dozens of them that are on septic tanks. I love them. But you just have to know what you're getting into. You have to have a higher maintenance expectation going in. And what that means is every other part of the deal needs to be a little bit better to overcome that and still be at 9, 10, or 11% returns. So that's what we see on this one.
Greg, I thought you were tired, man. You're out here spitting fire, dude. Like these last two things, you're just like in your zone, just dragging fire all over the place. It's amazing, man.
Dude, I haven't been able to talk rental properties. Actually, you know what? I had a caddy out there, and we were talking a little bit of rental properties. And the only time I went like par, bogey the entire time was when he was talking to me about rental properties. So you just get me going, man. I mean, it's natural. This is my happy place, right?
I love it, dude. I love it, man. Like you're just, I'm smiling because I know what's happening right now. So, okay. John Evans asks, are properties on septic tank harder to get rented, i.e. clients afraid of them? Now, I don't know, John, are you saying the residents are afraid of them, or are you saying that the investors as clients are afraid of them? Maybe you can address both.
He's probably thinking about the residents. That would be the only person who's fearful about renting them out. The answer is no. We do not see any difference between renting out a home on a septic tank versus city sewer. And we track it. So nope, no difference there.
Okay, sweet, man. All right. So I want to ask you another little detail here, right? I'm looking at this thing and I am not used to seeing $200 for water treatment fees. What is that all about?
Another really, big reason why most people either don't invest in rental properties, or maybe they try it once and they don't like it, and they turn themselves away from this really amazing asset class. It's because of all these things that they didn't know going into a rental property, right? Well, we know that there's water treatment fees that are associated with this property. Make sure that the water is soft and smelling good and all that other stuff. We have to spend $200 a year to do it. So for any cost that we know that is recurring, we're going to let every client know about that at the time of purchase, so that you're not surprised when this happens. And the kicker here is that factors into your return on investment. I mean, if you want to just delete that, Pablo, and see what the effect is on the return on investment.
Let me visually just put that there.
Yeah, there we go.
Look at that.
You know, so there's what, almost, was it a quarter point or almost a half a point? Yeah, it was yeah. There you go. Between a quarter,
40%, bro.
Between a quarter 40%. And a half a point.
Yeah. 40%, more than a third of a point.
And no other turnkey company goes to this length to point this stuff out. But we care so much. We're not interested in selling you one house, right? We want you to come on board, and your first purchase means so much. And I don't mean to discount just buying one home, because we love working with clients who want to buy one home. But we want to help you build this plan so that you can go and travel the world in 5 years or 10 years, right? And the only way that you're going to come back and buy numbers 3, 4, 5, 10 properties is if you have a great experience with numbers 1, 2, and 3. And so when we're putting these evaluations together, and that $200 expense is something that we know is going to happen for you, we're not just going to lump that into that 9% maintenance rate, right? Which has already been very conservatively, added upon because of the septic tank. We could easily lump that in there. And then that would increase our rate of return and make our assets more attractive to sell, and probably sell a little bit quicker. But we're not going to do that, because we want you to have a great experience. Our mentality is simply, if you bring great clients on and you just under promise and over deliver, even if it's just a little bit, right? If you can just tell people that you're going to do this for them and it comes in a little bit higher, you've had a client for life, right? So if we know that this expense is coming in, we put it on there. Most turnkey companies don't even know, because they don't do the same thing over and over and over again. They're in 5 different markets, right? They haven't done it enough in that specific neighborhood to know how the water smells in that neighborhood, and how you're not going to need a water softener or a water treatment, so this is that consistency angle, and this is how we can overperform. And then you want to come back, you want to buy properties 5 through 10, and we get you sailing to wherever you want to go. That's what we're trying to do.
I mean, literally sailing, right? Like, you have clients that you've planned this, like, stories. Yeah. Why don't you go tell us that story, man?
Yeah. I mean, one of the best stories that we have is a client named Jim and Stacy, and their whole dream was to build up enough passive income so they can go and take the Great American Loop, which, if anybody has heard of the Great American Loop, it's a really incredible boat trip, right? You can go and Google it now and you'll see it goes, you get on a boat, you go up the eastern seaboard, you go across the Great Lakes, you come down the Ohio River and the Mississippi River and all that good stuff. You spend 6 to 9 months on a boat, and that is what their dream was. So they came to us and they said, that's what we want to do. They had already thought that one of them could quit their job, the other one could go on a sabbatical, and if we could build up enough income for them, they could take their trip. So we broke that down into the right number of properties for them, right? They needed 10 properties. Oh, there you go. There's a Great American Loop.
Challenge accepted.
There you go. That was amazing, man. Your game is strong today, brother. So that's what they wanted. We broke down the amount of assets that they needed. They needed 10 properties. They needed to generate $8,000 a month in passive monthly income. That was 10 properties for them, and they are well on their way. I think they're at property 7 or 8 right now towards their plan, and they're gonna be looping it up in not too many years. It's and that's what we love to do.
That's so freaking cool, man. I'm so jealous. That's an awesome story, man. I'm glad I didn't want you to just move on from that one, because I know it and I really like it. It's really serendipitous that you're talking about the in-depth knowledge of the neighborhoods and water softening. I'm not kidding. Today's the first time I went surfing in the morning on a weekday, probably in about 10 days. And as I'm coming out of the water and I'm like, drying off and putting my board away, there's a firefighter and another guy that were literally just talking about, oh, I got to get this water treatment in my house because I live in Mayport. And, you know, now, and then the firefighter's like, oh, you know what that means? That means that like now it's going to, instead of itchy, you're going to feel kind of like greasy after the shower. But only a real expert in the market would know that in Mayport that's happening and not in the West Side or whatever, right? Like, interesting.
Yeah. I mean, there are literally 30 to 50 rental properties that we have built or renovated and currently manage within 2 miles of that house on Norca right there.
Yeah.
So we've been doing this for 15 years. So we know what it takes to have a really happy resident. And we have tried, I'm sure we tried on some of my first rental properties, I'm sure we tried to rent them out without doing that. And we realized that we needed to spend the money on doing that. And so, but you're not going to get that type of in-depth knowledge, expert knowledge, if you're just doing this yourself, especially if you're just, you know, from another part of the country and you're trying to be an absentee owner and trying to have some regular property manager handle this for you. It's just not going to work. You don't get to take advantage of the market of Jacksonville. And then you don't match that with consistent performance unless you have somebody boots on the ground who's been doing the same thing over and over and over again, like we have here. So that's how you win.
Yeah. And I was just kind of zooming in so you see where in Jacksonville this property is. So what neighborhood is this, Greg? Is this the north side that you call it?
This is the west side. So
okay, yeah, there it is.
West side is
downtown.
Yep. And the west side, you see I-10 there. I-10 is a major interstate, goes all the way out to California. There you go. So anything south of I-10 and then west of the river, that's the St. Johns River there, is that's the west side. And, you know, an area that, as I mentioned, we manage 3,600 rental properties in 4 neighborhoods in Jacksonville. And west side's one of them. So there's literally probably almost 1,000 properties that we manage just on the west side there.
All right, man. Well, Greg, this has been awesome, dude. It's been great to have you back, right? Like, super. By the way, that I-10 ends in the like the Santa Monica Pier, right? Like, I've actually driven the I-10 when I lived in Southern California and I moved back to Florida, right?
There you go.
You know, we don't have any more questions coming in. I think that this has been a great call. I think actually, you know what? I just spoke too soon. Mike
Shook
Foster.
the tree there.
Mike Foster coming in. Yeah, guys, listen, we got another at least 7 minutes here. So if you got questions, bring them on. Mike Foster. A few weeks ago during the JWB Q&A webinar, there was a discussion of JWB lender interest rates. Roughly 4% for employed W-2 investors and probably around 7% non-recourse loans for investors who live only on their investment earnings. But how about self-employed people? What would be a typical interest rate for JWB investor home purchases who don't have a W-2, but instead have their own income producing business?
So self-employed people generally, it's just a little trickier to get a loan than if you're a regular W-2 kind of vanilla loan out there. So I'm not going to have all the answers. It gets a little bit more tricky and there's a lot of variables. So what I would recommend, Mike, is if we want to get an answer for you, reach out to the team and then we'll make sure that we get a lender introduction for you with one of our approved lenders. They're really going to have an in-depth conversation, but you know, enough to be dangerous here. So generally speaking, if you're self-employed and you have been in business for longer than 2 years, you're going to be pretty good. You know, assuming that you are financeable by every other standard of what a typical W-2 employee is. That 2-year rule really matters. So if you're self-employed and it's been a long time since you started your business, probably you're not going to have any problems. You're probably going to get the same rate that everybody else who is a W-2 employee is going to get, which right now we estimate at 4% for interest rates, which is insanely low. So just because you're self-employed, don't feel like you can't get these great interest rates. You'll have to provide a little bit more documentation and all that good stuff. If you're less than 2 years, that's where it can get a little tricky. That's where I would probably just lean on you talking to a mortgage professional that we put you in touch with to get you, you know, a better answer on that.
Okay, great. And Guillermo Montes, who's now become a regular on the show, is asking, any chance to discuss the JWB investments in downtown? I asked him if he wants to discuss anything in particular, but Greg, maybe you can just talk in general about like all the cool stuff y'all are doing in downtown.
Yeah, we've made a lot of headway and a lot of noise lately in downtown Jacksonville. It's really fun because my business partners and I put this plan together to go really strong with our investments in downtown about a year and a half ago. And the funny thing is that all of these purchases happened within 3 out of the 4 purchases happened within a 2-week span in downtown. Go figure, right? You work on this for a year and a half, you put all the pieces of the puzzle in place together, and 3 of the 4 of them literally happened. They're like right next door to each other, and then they all happen within a couple of weeks. The other one was the Sweet Pete's building downtown, which was our first purchase, which is 2 doors down, and we bought that in January of this year. So there's a lot of activity, right? There's a lot of developer activity in downtown, even prior to JWB entering. But, we're quickly kind of becoming known for that part of downtown. And there was just another article yesterday where Alex, our president, was interviewed by the Business Journal and wanted to understand what our vision is for downtown. And, what we really believe in is, number one, to have a vibrant, urban, walkable downtown means an incredible amount to all of our clients and to JWB, because when you have a vibrant, urban, walkable downtown, property values rise in the communities that surround that downtown, right? We just had Steve Wernick on here last week prior to Melissa being here, and he has lived and seen that in Miami. Pablo, you've lived and you've seen that in Miami.
Correct.
Right? And that's what we're on the precipice of in downtown Jacksonville. Now, even if we see no additional appreciation and property value growth from downtown continuing to grow, Jacksonville still has experienced 4.3% average appreciation year over year. So we look at this as another cherry on top. If we can really make downtown work, then we potentially could see higher appreciation than that over the long haul. But we didn't just say that that's what we need. We really feel like we have an ability now. We have the platform now. We've been doing this for 15 years, that we can make smart, strategic investments in the downtown core, in commercial and mixed use properties in the downtown core, and really have an impact, become one of the kind of momentum movers here in downtown Jacksonville, because we're kind of clustering our activity. We feel that it's really important. Downtown Jacksonville is actually more spread out downtown than other downtowns in the state of Florida, right? It's like 3 times the amount of square miles as Tampa's downtown, right? So rather than, we want to get to 10,000 people living downtown, but 10,000 people living downtown together really will speed this whole flywheel up. So the 4 purchases that you see from JWB are right along Hogan Street and Julia Street, if you want to Google those. They're right next to Hemming Park, which is a major park downtown, right next to City Hall. And the Emerald Trail, which we were discussing with Steve Wernick 2 weeks ago, is that 30-mile long trail system, which is just starting to be developed. And the first section goes through an area of downtown called Brooklyn. The second section of the Emerald Trail comes right through Hogan Street. So we have always seen Hogan Street as being kind of one of the places in downtown that we can achieve urban, walkable vibrancy quickest. And that's why you've seen JWB make specific investments there. So we're really excited about it. And now, let's call it the next couple of years is all about us delivering on these projects. Some look very nice from the outside. Some are ready to be rented with commercial tenants, and some are a disaster inside. So we're going to be working hard to bring those to the full vibrancy. And it's going to be fun to talk about these projects for the next couple of years.
Super cool, man. We got 2 more questions I'm going to sneak in here, Greg. Of course, the moment that we think that we're getting out of here, it always comes in, which is awesome. I love it. Guillermo Montes rightly points out, same as the Beltline in Midtown Atlanta. Correct. That's another perfect example of an urban trail that has revitalized everything around it, right? Like the other ones that we know are the Highline in New York, the Swamp Rabbit Trail in Greenville, and Miami has this underline one coming in. This is what we talked with Wernick about. So Mike Foster says, sneaking in one last question. I know JWB wants its investors to have a great experience with their home ownership, and you occasionally request survey feedback from its investors to validate that. I also know JWB wants their residents to have great experience as well. Do you request similar survey feedback from residents?
So what Mike's talking about is our Net Promoter Score. This is something that we ask of our clients to fill out a 1-question survey. We do it every 6 months now. And we just simply ask you one question: how likely are you to refer a friend or a family member to JWB? And it's on a 1 to 10 scale, and we consistently are right around that 9 average score. So we're really excited about it. That's for the clients. You know, Mike, we haven't rolled it out to residents. Certainly something that I think we should look into. So haven't done it yet, though.
Yeah, interesting, right? Melissa said, and you know, to me, it was really profound, right? That the telling sign of if you're doing property management, right, is renewal rate, right? Like, I mean, you guys have that statistic, right? Like how often it gets renewed means you're doing everything all together at the same place. So that seems like a good tell-all statistic. What is, do you know your renewal rate?
Oh yeah. 70% is historically where we're at. So 7 out of 10 leases renew, and those were 2 and 3 year leases coming into it. So you would think it's harder to get renewals when you sign people up for 2 and 3 year leases coming into it. But yeah, 70% is our historical rate. We were just checking our company stats. We're at 70% so far this year. We were at 70% last year. Year before that, we were at 65%. So we continue to push the envelope, and 70% is where we're at now.
That's pretty epic, man. All right, last question, and it's Cassie Sparks. Welcome, Cassie. Happy to have you here. She is a newbie and single mom, one income, but wants to invest. I think it's awesome. She doesn't own a home yet and will purchasing a rental property affect my ability to purchase a personal home?
Wow, what a great question, Cassie, and so glad to have you here. This is a common misconception. Her question is, if I buy a rental property today, is that going to make it harder for me to purchase my primary residence in a year or what have you? The answer to that is no. So what happens is when you're buying a cash flowing rental property from JWB, it has positive cash flow. When the lender is looking at your profile and whether or not to make a loan to you for your primary residence, they're going to look at your debt to income ratio. When you have positive cash flow, what that means is you have more income coming in on the property than your mortgage payment. And so many times buying a rental property, a positively cash flowing rental property, if anything, it might even help you a little bit to get finance for your primary residence. Right now, if you go out and buy a rental property and you are underwater every single month, then that could be a challenge for you. It would make it harder for you to buy your next primary residence, but you're not going to find any of those with JWB. So what I would advise you to do is to make sure you stick to buying positive cash flow rental properties. And when you do that, especially after you've owned it for 3, 6 months, a year, most lenders will not have an issue counting your rental income going into it. So great question and a common misconception out there.
Yeah, actually, really good question, Cassie. We were literally just having this conversation right before this call because our guest coming up in 2 weeks is Jen Filzen, who is a longtime JWB client. She rents, right? She lives in Monterey, California, one of the most expensive markets in the world, in the US. And she's been renting forever. And she owns what, like 6 properties with y'all? Something like that?
Mm-hmm.
Yeah. So,
yeah. And her parents too. We love the Filzen family. They're amazing.
That's right. We talked about her parents too. Yeah. So like, that's not the only thing I'm going to tease here, by the way, Cassie, I'm considering that as well, right? Like I rent where I'm at. I've had long talks with Gregg about this. We run in the mornings and I'm always pestering him about, hey, should I just go in on JWB, buy a house, whatever, TBD. So I'll keep you. Oh, and Cassie lives in San Diego. So it makes perfect sense, right? Like Southern California, astronomical home purchase price, and it makes sense, but beautiful place. So I just teased Jen Filzen. That's in 2 weeks. Next week on Tuesday, so in 5 days from now, we have John Payton, who's the CEO of Gate Petroleum. He's a former mayor. So he is a billion-dollar company president and ex-mayor of Jacksonville. We're going to talk about, you know, his leadership skills, what makes Jacksonville special for recruiting the jobs that fill in the residents that, you know, that fill these homes, right? Like what makes your investment safe? And he's built $1 billion company here with that labor force. He's also heavily involved in the Chamber of Commerce. He knows everything about the Jacksonville economy and all that impact. Gregg, what do you think about that conversation?
I'm so excited to be able to have the chance to speak to John Payton. I mean, I don't feel right just calling him John. I feel like I should call him Mr. Payton. I mean, when you think about kind of people who are movers and shakers here in Jacksonville over the last, I mean, geez, within his family, I mean, it's been the last 30 years. But John Payton is one of those individuals who has done a lot for Jacksonville, a former mayor, and somebody who runs an incredibly successful and large company. I'm really honored that we get the opportunity to spend some time with him and pick his brain a little bit. So you all will definitely want to join us next Tuesday, 12:30 for the show. It's going to be an incredible opportunity.
Yeah, definitely. And listen, you like what you heard, you didn't like what you heard, you want to push your own numbers here, go to jwbwebclass.com, download that spreadsheet. So now, especially you, Cassie, if you're looking around and you are wanting to evaluate deals like this. And by the way, I put me too, because Luis Visco in the comments put, I'm excited for Pablo to get his first rental. I am too, Luis, but he only addressed it to panelists. So Cassie, I don't live in San Diego. Wish I did. But for the record, I tell Greg all the time, because I lived in Huntington Beach, California for 5 years. I think Jacksonville Beach is Orange County, California 40 years ago. And I've had multiple people that are from Orange County that live here tell me that they believe that too. So, so take the good with the bad there. But I love San Diego. Anyways, I digress. What was I even saying? I went way down the rabbit hole.
We were talking about web class.
Yeah.
Web class. And, and I really want people to know that, like, how it's important for you to be able to compare apples to apples when you're making a decision on rental properties. When you work with other turnkey providers, they're not going to show you the full picture between all profit centers. They're not going to show you how tax savings, principal pay down, home price appreciation actually factor into your returns, right? They're not going to create a space for you to have higher maintenance costs. If you know that you're on a septic tank and you need your maintenance costs to be higher, you can actually plug them in at 9%, whereas they're probably showing you 5%. If there's additional water treatment fees that come along with that property, you can plug it in. You can do all of this. We make it available for everybody. It's in our free investor toolkit. And so you get this for free. This is the same thing that Pablo and I enjoy doing with you guys on Thursdays. You can have the same conversations. It'll really help you compare this asset here in Jacksonville to your other assets in other parts of the country. And you can get that by going to JWB Web Class. Spend an hour with me. I'm going to teach you exactly how to choose the right market, what makes investing in rental properties successful, what doesn't. And then you get, that investor toolkit and that property valuation kit as well. So there you have it. Go for it.
Yeah. And last thing, because Cassie was asking about mentorship down in San Diego. I don't know about mentorship down in San Diego, but we have a Facebook group that has almost 1,700 people now that are all rental income property, either investors or, are looking into it. So Cassie, I recommend you I'll type it in here, but it's jwbfacebookgroup.com. It's just an easy hyperlink that gets you into that Facebook group, and you can join us there. And there is, all of our past content is there, all that stuff. Are you going to say something?
I remember Cassie. So the name struck a chord with me. I remember Cassie is in the group and asked a question in the group before. So she's come out firing with some really insightful questions. We appreciate your contributions, Cassie. That's
right. From last week, it was one of the questions that we had teed up to answer that we answered last week. Yeah. Welcome back, Cassie. Yep. Good to have you. Yeah. This is great. So I just want to say thank you for everybody spending, we had about 26, 27 people on the call today at one point. To take out an hour to hang out with us on a Thursday means the world to me. I want to welcome you back, buddy. Welcome back to the East Coast. I'm glad that you are doing well, that you didn't lose your wallet, and that you made it back okay, and you're in high spirits. And I'll leave it up to you to say goodbye to everybody.
Just a great time to be with you all. I'll keep it short and sweet today and not get too sappy like I normally am, but we appreciate everybody. And it's nice going away to golf paradise and coming back and hanging out with you guys on Thursday is a great step back into reality. So we will catch you guys next week, and I'll catch you in the group a little bit later. See you guys.
Adios.